Welcome to the last session. During the session, we'll continue our discussion of the tax treaty article by article. One thing I wanted to do, you will recall that last time we talked a bit about Section 897, the U.S. rules on real property, taxation of non-U.S. persons who hold real property. And I said that that was written in a manner which is meant to override treaties to the extent possible. And notice what it says here. It basically says is that anybody who is holding a U.S. real property interest will be treated as if he were engaged in a U.S. trade or business, irrespective of whether he was in fact engaged in a U.S. trade or business. Any investor that is not in a trade or business but just happens to hold a piece of real property, whether it's generates income or whether it's just, for example, raw land which he owns and which is not rented out. When that property is sold, even though there might be no taxation at all under sections 871 and 881, because there's no taxation of, generally speaking, a foreign person on capital gains, even though it's might be sourced in the U.S. This treatment, this fiction that as if the taxpayer is engaged in a U.S. trade or business, that effectively overrides that non-taxability and allows the U.S. to say, we will tax pretty much anything if it's a U.S. real property interest. And if you go deeper into the section, you find that a U.S. real property interest includes either a direct interest in real property or an indirect interest where a foreign person owns a percentage, or let's say owns shares in a company, a U.S. company, which itself owns real property, where the value is, again, I think it's over 50% of the value of the company is in real property. So it gets to an ability to tax somebody who indirectly owns real property as well. Now, I mentioned before the way the treaty language is, that it's even broader than U.S. domestic law. The treaty language generally would allow an indirect taxation of shares, even if the company that owns the real property is let's say, a non-U.S. company. So the treaty goes farther, allows contracting state to tax an owner of shares who sold those shares, whether the company is incorporated in the same country where the real property is or somewhere else. So the treaty is very broad on this area. The next area we want to talk about is Article 7. Article 7 is the business profits article. It matches, so to speak, or works in tandem with Article 5, which is the permanent establishment article. Now, Article 7 is in a state of flux as we speak. 2 years ago, in 2008, there was a report that was issued on attribution of profits to permanent establishments. Now, you might think, well, gee, this doesn't sound like a very complicated subject, but somehow they were able to create a report which goes on for 263 pages. You may be thinking we're going to cover all of that here, but no, I think we'll pass the pleasure and try to just gloss over things, so you have a very cursory appreciation of what changes there are. But the point is that if you get involved with an industry that uses branches or that involves permanent establishments, things can get very, very complicated. And getting into this can be very, very fascinating in terms of how you calculate things. The areas where there are particularly a lot of discussion in this are four. One area is sort of a general area which encompasses permanent establishments, let's say overall, no matter what industry. A second one involves banks. And if you, of course, think about it, you see a lot of branches of banks around. And in a lot of countries outside the U.S., U.S. banks, or banks from Japan, or banks from England, or other countries, operate in branch form. Not as a subsidiary that's separate in any legal sense, but they operate in a lot of countries as branches. So banking is a major area. Another one is global trading of financial instruments. And there's a specific chapter in this on that area, global trading. And then the last one, the fourth one, is the insurance industry, where again, there's an aspect of the common use of branches around the world, or taxability of permanent establishments. So there's a lot in this report, and it's something which you want to be aware of, so again, if it becomes important to you, you know where you can go for some guidance. Now, as a result of this report, we went from an OECD Article 7 as it currently exists, and as it currently exists is also pretty much the way it looks in most tax treaties. There's been a lot of uniformity in this area. But effective from this year, this is expected, these changes that have been announced are expected to be approved in July, and then at that time there would be a new one of these concise versions of the model treaty and commentary, which you should be getting off of the Source OECD website at that time. In any case, there's going to be these changes. We'll take a look at what those changes are briefly. Now let's first sort of walk our way through the OECD Article 7 as it is today, and as it's going to look for a long time in many, many treaties that are using it. Because it's only going to be slowly, as treaties are renegotiated, that countries change over to the new format. And that means as you go forward, you're going to have, in a sense, two approaches, and you need to at least have a sense of what the differences are. Now, this first paragraph, although the wording has changed slightly, is going to be pretty much the same as it is. And this is your basic thing that says that if there is a permanent establishment, then profits of the enterprise may be taxed, but only so much as is attributable to that permanent establishment. There's your basic language. The new one has been reworded. I won't bother to put it up specifically for you to compare, because essentially it gets to the same place. Paragraph 2. profits which it might be expected to make if it were a distinct and separate enterprise engaged in the same or similar activities under the same or similar conditions and dealing wholly independently. What is this? Is this truth or fiction? Are we speaking truth or are we creating a fiction?
Creating fiction.
Yeah, exactly. You're creating a fiction here. Remember, whenever we talk about a permanent establishment, that's part of the same legal entity. You've got a home office in one country, you've got activities in another country which happen to meet the thresholds of a permanent establishment as defined in Article 5. You have one legal entity. It's not two legal entities, it's one legal entity. You know, I keep assuming I can find where it is. You know, I pull a dollar bill out of one pocket and I put it into another pocket. It's one person. It's one legal entity. We're not talking about two legal entities. But this language tells you, uses a nice subjunctive tense, and says, this is a fiction. We will pretend that the activities inside that other country where there's this permanent establishment, those activities we will, in a sense, draw a box around. And we'll treat that like a separate legal entity. Now, let's see what difference there is in the new paragraph 2. There's a couple of differences. Okay, the first part says, for purposes of this article and Article 23A or B. Okay, what's that a reference to? What's Article 23 normally?
Elimination of double taxation.
Right. If a country has an exemption system, then Article 23A, I believe it is, will apply. If the country has a worldwide tax system and applies a foreign tax credit, then I think it's 23B that ends up getting put in its treaties. I may have that backwards between the two, but the point is this is trying to force, as we'll see later, especially in paragraph 3, it's trying to force on the countries uniformity of calculation between what happens in the taxation of the host what happens in the host country taxation of the permanent establishment, and what happens in terms of either exempted income or foreign tax credit. Now, I don't know whether any of you have been through detailed computations of that foreign tax credit limitation formula, which we have looked at probably 3 or 4 times during our discussions over this past quarter. But when you calculate that foreign source taxable income number, the idea is that your calculation of that in the home country, for purposes of the limitation, should be using the same principles as the calculation of the net income of the permanent establishment by the host country when it's extracting a tax. There should be uniformity. Notice, and this is sort of a basic point with regard to Article 7 as a whole, notice that throughout this thing it talks about profits of an enterprise. Take a look at this. Profits has a broad meaning, including all income derived and carrying on an enterprise. And remember, enterprise in Article 3 was pretty much defined to mean business. Profit, very broad thing, let's say the income from business activities. The reason I just brought this up now was because we're looking at this thing between, let's say, a foreign tax credit calculation, or the calculation of income to be exempted, and how much the host country taxes. When we look at that here, this concept of profits, we're not talking about the taxable income that each country calculates, because each country has its own rules. You're aware that the U.S. disallows a deduction for a certain percentage of entertainment expenses. Each country may have different depreciation rules. So essentially what they're saying here, though, is that profits in an overall sense, from which you then go and calculate a taxable income, that overall profits, let's say the economic income from this activity, that has to be calculated on a consistent basis so that there's not double taxation between the two countries. Now, later on, we'll talk a little bit more about, how do we calculate the income from permanent establishment. We'll try to get back to this there. But the point is, profits is not the same as taxable income. They're, in a sense, different concepts. But from profits, you make appropriate adjustments and arrive at taxable income. So you very much could have inconsistencies, but they will be inconsistencies because of domestic law calculations of taxable income, not because of inconsistencies in how each country calculates profits. And the new language is trying to force that on the countries. And sort of moving next into this paragraph 3, which is a brand new paragraph. Now, what does it mean when it says a contracting state adjusts the profits? Well, that's essentially a transfer pricing change under normal circumstances. Of course, there could be other adjustments, but most often it's going to be because of a transfer pricing issue that profits are adjusted. If there is an adjustment, this new paragraph 3 is trying to force onto the other country the same adjustment. So again, you're trying to get consistency in how those profits are calculated. Now, of course, the two countries might have differences of opinion on whether something has been properly calculated, but so that's then pushing to the competent authority dispute resolution approach, which you then have, of course, later on in the convention. I guess I see this as the OECD trying to, in a sense, flex its muscles a bit to try to force more conformity, more acceptance by two countries of adjustments that that one of the two countries makes in order to, let's say, reduce the administrative problems of dealing with the different issues that can arise where there's differences. Now, I said this number 3 is brand new. It was not there before. Let's go back to our current one. Now, looking at number 3, there shall be allowed as deductions expenses which are incurred for the purpose of the permanent establishment, including executive and general administrative expenses, whether in the state in which the permanent establishment is situated or elsewhere. Now notice I say that's deleted. This is talking about deduction of expenses against gross income. Well, gee, does this mean, since they deleted it, that we're no longer going to have any ability to deduct expenses? Is this going to be a tax on net income without the deduction of expenses? Well, no, it's not. The discussion as to why this is being completely deleted was because some countries would read this as limiting what expenses could be allowed, and therefore they wanted to just get rid of this. And of course, each country is going to use its own domestic rules to calculate taxable income. They didn't see this was needed to authorize the deduction of expenses. Now, when we get into that 263-page report, and of course some of the new commentary to the new Article 7, we'll of course find that there is discussion of expenses and how it's to be treated. So, but from the standpoint of the treaty itself, this is gone. The next one, item 4. The usual approach in calculating income of a permanent establishment is actual income attributable to that permanent establishment and appropriate expenses being applied against that. In other words, an actual calculation of income. What the current language allows is another approach, which is an allocation of total profits to its various parts. Well, what does that mean? Okay, in contrast to an actual calculation of real transactions to come up with a net income figure, this is saying calculate the worldwide net income of the organization and then on some basis decide what portion of that net income should be in this location of the permanent establishment. Now, if any of you have gotten into state and local taxation here in the United States, that's a very good example of allocation. You find a lot of states, again, the last time I looked at one was 25 or 30 years ago, so I can only assume that they're still the same. But hopefully still, a lot of states will take the total income of the company and they will say, how much was there in the way of sales within the state versus all other states? How much payroll was for people's services inside the state versus payroll for the company as a whole? And then thirdly, how much property do we have in the state? And we calculate that in comparison to all property of the company, no matter where it is. And we come up with an average percentage that says, for example, 7.3% of the total income of the company will be treated as income of the state, and that's how we tax it. So this rule in the model treaty allowed countries to do that. Now, as you might appreciate, this is the OECD, a club of, relatively speaking, economically developed countries. Maybe on an overall basis, most often companies that are in these developed countries that are forming branches, have permanent establishments in other countries around the world, it might be fair to say that on average there's more income being earned in the home country than necessarily out in the hinterlands where these permanent establishments are. Or maybe in some cases there's startup losses in these locations. If you have, relatively speaking, a higher level of profitability in the company's home office, so to speak, or within the home country, and you then use an apportionment of profits approach, you're possibly artificially increasing, maybe on an overall basis, increasing how much net income gets taxed in the location where the permanent establishment is. my guess is that what's really behind this is that the OECD, being the rich club it is, would rather see an actual computation of real net income rather than an apportionment. So they came up with the thought that, well, the new rules, are really great and they should be applied by everybody, therefore we will eliminate this ability to have this worldwide apportionment of income. So they got rid of this. Well, let's do item 6 first, and then we'll go back to item 5. Item 6 says profits should be determined by the same method year by year unless there's a good and sufficient reason to the contrary. Now that sounds sort of like motherhood. Why would they ever get rid of something like that? Well, the thought was that just as with item number 4, that there's no longer going to be allowed an apportionment approach. There's a general narrowing of the alternatives as to how you calculate the profits of a permanent establishment. And therefore, they're trying to force everybody to use that approach. And once you use that approach, well, you're automatically using that approach year in, year out. There's no alternatives like an apportionment approach allowed any longer. Therefore, the year-by-year consistency no longer has to be stated. So they got rid of that. Now let's go back to paragraph 5. Now you may recall, if we were to quickly look back at Article 5, and if we were to look at paragraph 4, and these were the exceptions to a permanent establishment, we saw that item D, fixed place of business solely for the purpose of purchasing goods or merchandise or of collecting information. So we talked before about a purchasing office being not a permanent establishment. Now, as you can perhaps imagine, if there is a provision saying that a purchasing office will not be a permanent establishment, then if you happen to have a permanent establishment because you're doing not only purchasing for the enterprise, but you're also doing something else that causes you to have a permanent establishment. If that's the case, well, there's some logic that would say, well, okay, the income, to the extent you have profits that are attributable to those purchasing activities, you would treat those as being not taxable and not part of the income attributable, not part of the profits attributable to the permanent establishment. There's some logic to that. Now, why would they delete this? As we'll get a little bit more into later, we will find that the overall change, or one of the important parts of the change, is to treat more seriously this separate company fiction. And we'll see as to how that, what that leads to in a little bit. But one of the things it leads to is a conclusion that if you're serious about this separate company fiction, then if you have a permanent establishment and purchasing happens to be an activity, and if that purchasing activity does in fact have some value, why shouldn't there be a profit element that the host country can tax? This is contrary to the, in a sense, the interest of the developed countries. And I don't have a sense as to exactly why they decided to give in on this. Perhaps there's a little bit of theory behind it, but I suspect also that maybe they felt like they were trying to be fair in taking some things away from developing countries and giving this in return. I don't know. I'm speculating on that. But this is, in a sense, inconsistent with a lot of the other changes. Okay, so we've gone over all of the deleted ones. Number 7, which is essentially the same in the old and new, is an ordering provision. And basically says that although something is business income, if it is treated in some other article of the treaty, then you don't tax it under Article 7, you deal with it under a different article. So what's an example of something like that, so you get a sense of what this means? Let's say that you have a company which is earning royalty income. Let's say it has a business of developing inventions and licensing them out. So it has a stream of royalty income from the source country. Is that an item of business income or covered by Article 7? Or is it an item of royalty which is covered by Article 12? We'll eventually get to Article 12. If there's no permanent establishment and it's covered by Article 7, then of course you would say, hey, great, no taxation. If it were covered by Article 12, royalty is a bad example for looking at the OECD treaty because the OECD treaty says no withholding on royalties. But let's assume that probably 90 or 95% of the treaties out there do have a withholding tax on royalty, contrary to what the OECD wants. So let's assume we have a normal treaty that does have a withholding on royalties. Let's assume 10%. Now typically, in the article on royalty, and we'll see that eventually later, there will be a provision in that Article 12 which says, however, if there is a permanent establishment in the country of source, and that royalty is attributable to that permanent establishment, then you go back to Article 7. Then you go back to Article 7. So the result is, if there's no permanent establishment, you have using our example, a 10% withholding tax on gross. Under Article 12. If you do have a permanent establishment, then it will be a tax on net, taking into account all expenses. Now, when might, again, to give a little bit more, hopefully a little bit more substance to this example, when might a company that is receiving royalties, such as I've described, when might it have a permanent establishment? What might cause it to have a permanent establishment in the country of source? I said this was a company which finds new technologies and then has a business of licensing those technologies out to whoever it can find who would want to be a licensee. Do you think licensees ever need to be sold on the idea that this is a great technology that they should license in the first place in order to sign on the license agreement. So there's potentially sales activities. Do you think perhaps a licensee would ever want some technical support with respect to the application of that technology within their operations? Yeah, could happen. So the point is, a company that is licensing as a business might want to have a local office to conduct these kinds of sales activities or service activities of its licensees. So this is something where, yes, there could potentially be a permanent establishment, and that the licensing income could reasonably be attributable to that permanent establishment. This paragraph 7, in conjunction with a paragraph in, for example, the dividends article, the interest article, the royalty article, the real property article, and others. I shouldn't say the real property article, because that's going to be taxable whether it's one way or another. But if you do have a permanent establishment in the real property situation, then maybe you get taxed on net as opposed to, again, a tax on gross. But in any case, there's consistency between the two, and it allows you to figure out ultimately, okay, which article applies to the particular type of income. Okay, now let's next take a look at the UN model treaty. This is getting back to the basic question of what's taxable. The OECD model talks about profits that are attributable to the permanent establishment. But notice what's in the UN model. So not only what's attributable to the permanent establishment, but also any sales of goods or merchandise similar to what's being sold through the permanent establishment, or business activities that are similar. So even though the permanent establishment, the people at the permanent establishment are not involved at all, this one brings that in. Now, what does that sound like? Remember, we've talked before at some point about the force of attraction doctrine. In the U.S., we have a very, very complete and full force of attraction doctrine. If we look at 864, it says, all income, gain, or loss from sources within the U.S. shall be treated as effectively connected with the conduct of a trade or business within the United States. And the exception is the fixed and determinable annual periodical income, which is not included in that. But any business income at all that is otherwise there gets sucked in and taxed as being income of that effectively connected activity. So the U.S. has a full, in a sense, a very full force of attraction. However, this in the UN model you might call a modified force of attraction. Things that have, in fact, nothing to do with the permanent establishment, but because they're of a similar nature to what's going on there, they get sucked in. So you might call this a modified force of attraction. Now let's go back to that fiction that we were talking about. We have our usual picture here. This is our PE. We have, of course, the two countries. We have X. And our goal is to draw, in a sense, a line around here and to come up with a profit which will be the profit of that PE. And again, remember we looked at paragraph 2, and we said that paragraph 2 is going to be on this fictional basis of the PE as if it were a separate legal entity, as if it were conducting its own activities independent of the organization of which it is a part. Look at the new language for paragraph 2. I think when I put it up before, we got onto the first line, but we didn't get down below. Notice where it adds in, taking into account the functions performed, assets used, and risks assumed. Does that sound familiar, those 3 items? Does that sound familiar at all? Does anybody remember our using those 3 terms when we talked about transfer pricing? When we talked about how to try to say where is their value, in what location. This is trying to emphasize that we will actually look at the activities that are being conducted, and we're going to really come up with a hard number, effectively, as what the profits are, taking into account who's doing what and where he's doing it. It's probably reasonable to look around and say, okay, gee, functions performed. Okay, well, you can actually look at people who are in each location and say, what are they doing? You can probably look at the assets. Certainly if it's a table and chair, that's pretty obvious as to where it is. With intangibles, it can get a little more fuzzy, but if you've got a valuable customer list, and all the customers are in that country, well, probably the value of that customer list is there in the country. But what about risk? How do you decide where a risk is? What that 263-page report gets into is some reasonable amount of discussion on this. In a sense, I think what it tries to do is say that the location of risk really follows the location of the decision makers who have authority over how risk is to be implemented. For example, let's go back to assets used. So, for example, let's say that in this permanent establishment, let's say that there's a building that is owned by X. Is that building an asset of the permanent establishment? Normally, on the surface, you'd say, well, gee, it's pretty obvious that it is. It's a building. It's physically located there. But under this more strict approach, they really say, well, who manages that building? Who was involved in making the decision to buy it? Who really has authority over who is going to decide how it is to be treated, maintained, rented out, sold perhaps? And factually, it may be found that, well, the building is really owned by the home office of X and is not considered to be really an asset of the permanent establishment. If that's the case, well, but wait a minute, we're trying to figure out what the profits of the permanent establishment are. And we've got this Hippocratic oath, so to speak, to apply this separate company basis. What do? Essentially, what they are telling us is that if the building is considered to really be a home office asset, then that means that the branch, the PE, to the extent it uses that facility, is going to have to calculate an amount of rent. It's not real, of course. There's no lease between a landlord and a tenant, but there's a fiction, and we've got to do things consistent with that fiction. So we will have to calculate a rent that the PE will, in theory, pay to the home office for the use of that space. And we should use good intercompany pricing to determine how much rent it should be. So when we decide on what our profits are, that's part of the profit calculation, a deduction for a pretend rental. It's quite serious in terms of this as if separate company basis. Let's talk a little bit more specifically about how we go and calculate those profits. Let's say that X is, again, a manufacturer of some product. It manufactures it in country A, and now the PE here is really a sales office, and it's going to sell to customers. Let's assume that product is inventoried inside country B. The permanent establishment takes care of it, manages that inventory, and makes sales. An obvious question is, how are we going to calculate a cost of goods sold for the calculation of profits of the permanent establishment? Let's assume the sales price is 100. Let's assume the manufacturing cost is 60. There's a difference of 40. How are we going to calculate that? Now, this is only one thing. We then get to expenses and so on. But in the big scheme of things, what the rules are telling us is to take a two-step approach. First, do a functional analysis, which looks at those risks and assets and activities and figure out what's being done where. Then the second step, use good transfer pricing concepts to come up with an answer. So if we looked at this 40 of difference, what we effectively have to do, because of the fiction that this is a separate entity, we have to come up with a transfer price. We have to figure out, if X were selling to an unrelated party, how much would he sell for under these circumstances? Now, as you can imagine, it's bad enough when there's two separate legal entities, real legal entities. At least in that case, there's going to be an invoice. There's going to be real legal documentation that is respected. Very often, for importation, of course, those documents are looked at and are there. Here, this is all within one company. It's a fiction that there's two. So there's no legal documentation other than maybe a declared value at the time of importation. There's no documentation at all other than potentially self-serving internal documents that you create to suggest what that value is, what that transfer price is from the home office to the branch. So this is an extremely fuzzy way to go. And then you get to these other questions I mentioned about intangibles. Well, gee, who's making the credit decision? And what effect should that have on the transfer price? So this can get very fuzzy. In any case, difficult as it might be, we need to actually calculate a transfer price for the inventory that's transferred from the home office to the permanent establishment. So we need a transfer price. What about expenses? Interestingly, assuming I can find it quickly. Paragraph 3 of the UN Model Treaty, which is saying what expenses can be deducted. And notice the part in bold, that no deduction shall be allowed in respect of amounts, if any, paid by the permanent establishment to the head office by way of royalties or similar payments in return for the use of patents or rights, or by way of commission, or services performed, or for management, or whatever. Let's think about that and look back at the current theory versus the new one. And again, remember that the current theory is going to be around a long time because it's going to be very slow that treaties are renegotiated and the new language is inserted. And I can imagine that in some renegotiations, the parties may not like the new approach and may stick with the old approach. What do we mean by this? Personnel back at X may be doing some important functions. Some of you will be within perhaps the home office tax group, or within the in-house counsel function. And you may be performing some very significant support for the activities of the PE that benefit the PE. What should be charged against the income of the PE to come to the proper profits figure? Should it be just your actual cost for the hours spent working on this? Or have you performed a service which we should recognize as a service which is valuable and which you could sell to third parties at some price? Now, under the current rules, which are stated, let's say, relatively clearly by the UN model language, which of course is still the UN model language, we don't create a profit element for your services as counsel from the home office doing something for the permanent establishment. Rather, we calculate what's the actual cost of providing direct services, and those amounts are charged against the gross income to arrive at profits. We don't create a profit in the home office attributable to your services. That's been the theory up until now. The new rules would say, yes, you've done something. It's valuable. We should figure out what a proper service fee would be for your efforts. Now, if it turns out that that service fee is less than your actual cost, then maybe you should be worried about your job, but that's a different issue. What about royalties? Under the old rules, you definitely would not have a situation where the home office is, let's say, allowing the use of some intangible property to a branch, to a permanent establishment. There would not be any ability to deduct a make-believe royalty. Rather, if the company as a whole, if X as a whole is paying a license fee to some third party, okay, fine. Then we can take the portion of that license fee which is actually attributable to the PE on an actual basis, and we can include that in expenses. So we include real expenses. For example, let's say that X is paying Microsoft, for 1,000 computers, and 100 of those computers are at the location of the PE. So the software is being used there. Okay, that's an actual fee that X is paying to Microsoft, and 10% of that is actually used within the PE, so that 10% of those actual costs would be deductible in arriving at profits of the PE. Under the new rules, with this stricter treatment of the permanent establishment as a separate legal entity, if in fact X has its own intangible property, maybe it has created a computer program of its own that is proprietary, and it allows the permanent establishment to use that. Again, it's part of itself. Legally, this is nothing. But Under this fiction, we now say, well, there is a license of whatever this proprietary software is, and we need to come up with a number as to how much the license fee should be, how much the royalty should be. And we use that to calculate the amount. Now, this is, I think this is probably enough at this point. You're probably overjoyed by my saying that. But I think at this point, in order to just have a sense of what's there, I think this is probably enough detail. Again, you're going to have the old rules there for a long time, and the new rules will come in slowly. Yes, Pete?
Isn't that going to get really complicated with things like trade secrets and know-how and so forth?
Oh, absolutely. This is going to be terribly complicated. And in fact, one of the things I had in my notes was that all of this complication, and I think I said it also in the overview, this sort of complication is a good reason why, if you can, don't operate in branch form, operate in subsidiary form. Or if having a branch really makes sense because of other factors, for example, maybe it's a country that has a high withholding tax on dividends, but has no tax on remitted branch income, so that having a branch actually has a lower effective tax rate. Instead of having it be a branch of X, we have X form a subsidiary, and that subsidiary forms the branch. So that you at least, as much as possible, have a separate legal entity, so that in this kind of case, 100% of what's in that subsidiary is the profits of the branch. Now, for most countries, this is good planning. Interestingly, as I think several of you may have seen from your choice of Japan as a country of, for assignment 3, a few years ago, Japan said, we don't like that kind of thing. And as a result, they would disallow that and force you into a Japanese company. But be that as it may, that's unusual. Most countries certainly do not have something like that. Okay, let's just spend a couple of minutes just mentioning a couple of things about Article 8, which is shipping, essentially shipping and air transport. Now, you'll see from the first paragraph that what's important in the model treaty is the place of effective management. It's essentially saying this is the only place where where taxation can occur. Well, what does this mean? What if X over here, which owns a ship, happens to have a sales office and let's say it picks up, this is country A, country B, it picks up, it sells tickets, it picks up passengers and freight. What about that? Does that sound like a permanent establishment? If it has an office which is doing all these things, remember our criteria for a permanent establishment were location, duration, and activities through that location, business activities. Oh, gee, this sounds like real stuff. Well, Article 8 is saying, well, forget that. Whether there's a permanent establishment or not, no taxability, only in the country of effective management. If effective management is in country B, then yes, it's taxable. But if effective management is in country A or country C or X, or not X, some other country, then it's going to be taxable wherever that is and not in country B. The model treaty, of course, uses place of effective management. Do you expect U.S. treaties to use the same language? The U.S. focuses on place of incorporation. So U.S. treaties most likely would refer to place of incorporation. Be aware also that in domestic law, I want to say 883, anyway, whatever it is, there's an exemption, what's called a reciprocal exemption, which essentially says if a shipping company of my country, when it goes to your country, has an exemption, then I will grant your vessels, your companies that come to the United States, I will grant an exemption. So it's called a reciprocal exemption. It's something that's worth knowing about, that it's in the code. This next area we'll speak about a little bit, because obviously we're quickly running out of time, is Article 9 on associated enterprises. This is essentially the transfer pricing article. To try to bring out one or two points in this, notice paragraph 2. This is similar to the situation we talked about on paragraph 7 before, saying that if one country makes an adjustment, then the other country should be making the same adjustment. And of course, just as in the language in paragraph 7, it may be that the two contracting states will have to consult each other and figure out what the right answer is through the competent authority procedure. This you might call a primary adjustment. In other words, one country makes an adjustment, the other one hopefully will make a similar adjustment so that there's no double taxation. There's also in a sense, a secondary type of adjustment which you don't see here because the model treaty is silent about it. Let's say that X owns Y 100%, and X has made a loan to Y, and there's, of course, interest paid. And let's assume that the rate of interest was 10%, but Y, country Y says, well, gee, that 10% was too high. It should have been, let's say, 6%. And as a result, you paid 4% too much. When country B says, okay, Y, you will have to recalculate your income and increase it by that 4% that should not have been expensed. Now that's simple enough. But what about that 4? Should there be a secondary adjustment that if X does not actually return that 4% to Y, how will that 4% be treated? Because there actually has been a transfer of 4 from Y to X. Country B might ignore it. Country B might say, such as the U.S. would, that if there is an amount transferred from Y to X that has no basis, because of course the only proper basis was a 6% interest charge. So the excess had no basis for payment, no reason for making the payment. Therefore, taking the U.S. approach and a number of other countries as well, that really constitutes a distribution with respect to shares. And if you have a distribution with respect to shares, well, if there's men in the United States earnings and profits, you have a distribution that is a dividend. So the point I'm making is that the article is silent on this. It leaves countries to do whatever they want on these secondary adjustments. Now, the next area that we'll chat about a little bit is the dividends, interest, and royalty articles, because they have some similarities as a group. So we'll try to cover a few things. You'll notice that paragraph 1, and this is going to be true for Article 11 and Article 12 as well, is saying that the country, the residents, the home country, can tax. Dividends paid by a company which is a resident of one contracting state to a resident of the other may be taxed in that other state. So if we have our usual picture, paragraph 1 is saying that that country A can tax that dividend in the hands of X. And again, in the interest article, it's the same thing. In the royalty article, it's the same thing. If we then look at paragraph 2, we now see we're talking about the ability of country B to tax that payment. And in Articles 10 and 11, within the OECD Model Treaty, there's a similar thing. In Article 12, because the OECD wants to exempt royalties from any tax by the country of source, we of course find that paragraph 2 says it's not taxable by the country of source. Now, you typically find that there will be some sort of suggested limits. Now, here in the OECD treaty, they actually put in some percentages. If I remember correctly, I think in the UN Model Treaty, they just put blanks, suggesting, of course, that countries will be free to negotiate whatever they want. Of course, the OECD model is not an obligation on any contracting state, so this always becomes an area of negotiation just as much. But the OECD model does at least put in percentages that are suggested. Now, notice that these are maximums. Under normal circumstances, if domestic withholding is lower than these amounts, then the domestic rules normally will apply, the domestic withholding percentages. If I remember correctly, I think Japan was one place where occasionally the treaty rate is higher than domestic, and the country will actually withhold the higher amount, which isn't very nice.
Why would that be?
Pardon?
Why would that be?
Well, I presume, I don't remember whether I've ever actually looked at the why. I just remember that that was the case. But I suspect that it's because within the domestic law, it says whatever is in the treaty will effectively override and replace domestic law. I assume that's the case, although I don't know that for a fact. So these present upper limits. A local country can calculate its tax in any fashion it wants, but these become upper limits. Notice there's a paragraph 3, a definition of what a dividend is. And although there's a reasonable amount of language there, which talks about different things, it really gets down to what does the country of source characterize the payment as. That's pretty much the substance of this. What is the treatment under the laws of the country of source? Notice paragraph 4. Provisions shall not apply if the beneficial owner carries on a business through a permanent establishment and the dividends in this case are attributable to that. Then Article 7 applies. This is the item I was referring to earlier when we talked about Article 7. Now let's go back for a moment to over here. The beneficial owner. Pretty much most treaties now refer to beneficial owner. So what guidance is there on what that means? Now this is from the OECD commentary. This last part, which focuses on the purpose of the convention, avoiding double taxation and preventing fiscal evasion and avoidance. Clearly that's a pretty subjective area, but it's meant to be broad. It's meant to try to get at, let's say, parties who are treaty shopping. It's meant to give quite a bit of flexibility to the state of the country of source to look through what taxpayers may be doing to try to obtain treaty benefits. And there's some further language here. I think this is particularly good guidance because it's saying look at what ability the recipient of the dividend or the recipient of the royalty or the recipient of the interest has. What ability do they have to use that income? You may recall the discussion we had about the Indo-Foods case. And remember, the interest and principal payments came in, and whatever came in went out under a back-to-back. Joey, remember the use of the term, which probably you have indelibly etched on your mind now. Under a back-to-back loan arrangement. There was no ability of that company in the middle, which was a Mauritius company, to do anything with that interest, with any amount of the payment. It had to immediately turn it over to somebody else. Now, if you have that kind of situation, be it dividends, interest, or royalty, you can pretty much physically look at what legal responsibilities does that company have to act in certain ways that are preordained. If there are such restrictions, then, well, maybe it's not beneficially owned. Now, also from a guidance and planning aspect, well, gee, how can we show that there is control so we have the strongest case? Well, if we have a back-to-back loan arrangement, maybe we can vary the, again, this is assuming related parties and we have the choice, but maybe we have semi-annual interest payments and the interest comes out and then sits in the company for 5 months before it goes out on the back part of the loan. Does that, clearly make it Okay? Well, probably not, but it makes it a lot better than if there's only 1 day between. Having 5 months of total control over what to do with that amount. And what about the directors of the company? Are the directors of the company the same people who are the directors of the ultimate recipient of that interest? So that there's uniformity of directors. Well, maybe you want to have different people. So there are things that you can do to try to, let's say, give yourself as strong a position as possible to achieve at least what you are trying to argue is control. Now, one of the items which you received, there's an article here which is specifically on beneficial ownership in China. If this, for example, let's say is the US, and this is Hong Kong, and this is China, we have W down here, let's say it's going to pay a dividend to Y in Hong Kong, and then a dividend, of course, back up here. Now, this is looking at the question as to whether Y has beneficial ownership of the dividend, or of the interest, or of royalty. Before these beneficial ownership rules were published, China was a very, very form-oriented country. Now all of a sudden it's gone to the other extreme, and if Y doesn't have some sort of independent business activity, this circular that came out last year would give local authorities the right to say, gee, just having that company there isn't enough. If it's not doing something, if it doesn't meet some of these tests that are set out in terms of activities and functions, then we're not going to give you the benefit. And what's the practical effect of that? Under the Hong Kong-China arrangement, a dividend should be taxed at 5% withholding. But if that's not allowed, you're looking at 10%. Plus, of course, the administrative cost of forming and maintaining a Hong Kong company, which probably is not that much in the great scheme of things, but it does take time and effort and money. Looking at paragraph 5, what's that about? Let's illustrate what that is. Let's assume, for purposes of illustration, that 100% of the activities of X are carried out through the PE, and as a result, there's no activities back in country A. Everything is in country B. And let's also assume that country B does not impose a branch profits withholding tax or a branch remittance tax, but rather applies, of course, a dividend withholding tax of, let's say, 10%. When X pays a dividend to its shareholder, country B would be, let's say, ethically right or morally right in perhaps wanting to tax this dividend and apply that 10% withholding tax, because all of the income was earned inside country B. Gee, would the U.S. ever do this? Would the U.S. ever, if country B were the U.S., would the U.S. ever try to tax this? If I remember correctly, under the sourcing rules, a dividend payable by a non-U.S. company could be U.S. source to the extent that some percentage of the income of the company or the activities of the company are carried out through a U.S. trade or business, then the dividend that is paid can be U.S. source. So this article in the treaty is preventing that. It's saying that the U.S. or country B cannot apply a tax to a dividend paid by a resident of the other contracting state. So no ability to tax this dividend. Does the U.S. have an undistributed profits tax? Does 531 sound familiar? The point is that because there can be tax savings, at least a deferral of tax, to the extent you accumulate earnings in X and do not pay a dividend. Some countries would say, well, if you don't pay enough dividend, we will tax you on the amount of earnings that you did not distribute. This is saying that country B cannot apply such an undistributed earnings tax to X under the AB tax treaty. That's why paragraph 5 is there. Taking a quick look at the interest article. Again, remember we said that paragraph 1 allowed the country of residence to tax. Paragraph 2 allows the source country to tax, but the maximum is 10%. And again, 10% is of the gross amount. And if a company is heavily leveraged, what does heavily leveraged mean? Joey? That's another good expression. What does heavily leveraged mean?
The company has a lot of debt.
Yeah, a lot of debt. So maybe it has a lot of interest income, but it also has a lot of interest expense. Well, 10% of gross does not take into account the fact that maybe there's only a small margin in between. There can be economically difficulties with this tax on gross versus the fact that the company in its home country is taxed on net. Now, notice the definition of interest in paragraph 3. This is a pretty broad definition, and there's a couple of interesting points that you run into. Notice this part here, whether or not carrying a right to participate in the debtor's profits. Has anybody ever heard the term equity kicker? I make a loan to you for you to use in your business. Maybe we agree a below market rate of interest, or maybe zero interest. But the amount that you will pay me back will be the principal plus a percentage of your profits. That would be an equity kicker. This is saying that the country acknowledges that interest does not have to be just a flat percentage. A few times back in various countries, China most recently, I would ask somebody whether an equity kicker loan was possible. And the immediate response is absolutely not. They would never allow anything but a normal percentage of principal. Well, gee, why does the treaties, all of the treaties that China has, why does it define interest this way? They must have decided that, yes, that was theoretically possible. So this is something that countries actually enter into and, in a sense, acknowledge that you can't have interest which is not a mere percentage of the principal. And notice the last line, penalty charges for late payment shall not be regarded as interest. Paragraph 4, of course, looks like the issue that we looked at on dividends, which is the permanent establishment article. Now notice paragraph 5. This one's pretty important. Now let's take the first example. We have a simple X and Y, A and B, and Y is paying interest to X. Which country is the source? Which country is the source? What was the basic rule? Shall be deemed to arise in a contracting state when the payer is a resident of that state. So general rule, Y is a resident of country B, it's paying interest to a foreign person in country A, and under the AB treaty, the interest would be sourced in country B. That's nice and straightforward. Now we have company X with a permanent establishment in country B, and let's say that Y is up here, and Y is receiving interest from X. Now let's look back at this again. Where the person paying the interest, whether or not a resident, has in a contracting state a PE in connection with which the indebtedness was incurred, and such interest is borne by the PE, then the interest shall be deemed to arise in the state in which the permanent establishment is situated. So now the question is, what was that loan for? And is the interest a proper expense of the calculation of profits in the PE? Now let's assume that we decide that yes, that interest is being paid because the loan was to finance, let's say, an office building that's down here, and that the interest is very clearly an expense down here, interest expense. Now this is saying that under the AB treaty, the source is country B. It is not country A. Now you have the exact same thing in the royalty article. Same thing in the royalty article. That sourcing will be based on this kind of issue. General rule on where the payor is resident, but if there's a PE and the PE is in a contracting state, then the source is at the location of the PE. This always takes me a moment or two to try to get the picture right, but let's say that we have A, B, and C, and let's say that we have X, and let's say that X has a PE in country C, and let's say that X is paying interest or royalty to Y in country B. Let's assume that yes, the interest was attributable to the PE and was borne by the PE. Remember, we said the general rule was that the interest or royalty will be deemed to arise in a contracting state when the payer is a resident. That's the general rule. Where, however, the person paying the interest, X, whether or not he is a resident of a contracting state, has in a contracting state a PE in connection with which the indebtedness was incurred and it's borne, then it'll be sourced at the location of the PE. There's two possible treaties here. There's the AB treaty and there's the BC treaty. Now, let's say we are looking at the AB treaty. What is the source of that interest or royalty? The location of the PE is in country C. The treaty we're looking at is A and B. Does the general rule apply, or does the exception looking to the location of the PE apply? Which one applies?
Exception.
Okay, but the exception said the permanent establishment has to be in the contract, one of the contracting states. So the exception does not apply. Therefore, the general rule is that under the AB treaty, A is the source. Now let's look at the BC treaty. Under the general rule, we know that the country of residency is country A, so it's not country C. So we know the general rule would not, cannot apply to this situation to make it, make the interest or royalty sourced in country C. But if we look at the exception, again, the exception is where is the PE? Is it in one of the contracting states? Yes. Does it matter that X is not resident, that the payor of the interest is not resident in country C? No, it doesn't. It specifically says whether he, the person paying the interest, is a resident of a contracting state or not. So X, the payor, does not have to be in country C for Y under the BC treaty to figure out what the source is. So under the exception, because the PE is in country C, interest is sourced in country C. Now what does this mean? It means that country A has the right to tax under the AB treaty, and country C has the right to tax under the BC treaty. Now that's a terrible result. But the treaties do not solve this problem. This means it's very important when you have permanent establishments that are bearing the cost of royalties or interest to be very much aware of the potential for two countries to tax the same item, actually three countries to tax the same item of income. Because of course country B, which is the country of residence of Y, is probably going to tax it as well. So you've got three countries taxing the same item of income. So terrible result, but the treaties do not give you a solution. You've got to create a solution by not having the problem in the first place.
Would there also be a problem of C trying to get at the money in B? For example, if there is no treaty between C and B?
Oh, sure. Then you, of course, go to the domestic law of country C, and yes, a reasonable number of countries will want to tax things that are things like interest or royalties that are charged against the income of a permanent establishment. Yeah. What about the U.S.? How would the U.S. handle this, assuming this is interest? Forget royalty for a moment. How about interest? Any idea how the U.S. would look at this? U.S. is country C. Has anybody in the inbound course, has anybody looked at Section 884, which is your branch tax? The branch tax in Section 884 has two components. One is a dividend equivalency tax, which is this branch profits remittance tax that I have spoken of a few times. But the U.S. In Section 884, if you go down a few more subsections, you'll eventually find a branch profits interest tax. And that is looking specifically at this kind of situation and is saying that there will be a tax to the extent you have this kind of situation. It's a little bit complicated, but as to how they exactly get to it, but this is essentially what's happening. And you can imagine that Y up there, who is receiving interest, is not expecting there to be any taxability of that interest in the United States, in country C here in this situation. This can create potentially some unexpected results that bother very much the recipient of the interest. a loan agreement very often will push back on the debtor X unexpected taxation like that. Sometimes you'll find that. So that gets to the question of legally who ultimately has to bear the cost, but the taxpayer legally might still be Y. Article 12, which is royalties. As I've said, because this is the OECD model, paragraph 1 grants the country of residence the right to tax, and there's no paragraph 2 that corresponds to the dividend and interest articles, because the only one that is allowed to tax is the country of residence. OECD, of course, wants royalties to be tax-free by the country of source. Reality, again, is that most countries do have a paragraph 2 that defines some minimum level, whether it's a 10% withholding or something. Notice paragraph 2, which is the definition of royalties. Now that one's pretty important to look at closely. Sounds pretty broad. Okay, now let's go to the UN treaty. Okay, now notice first of all that there is a paragraph 2, and again a blank for how much withholding tax would be the maximum. Notice paragraph 3. Do you notice anything that's different about this one from the OECD model? What about that part that says, for the use of or the right to use industrial, commercial, or scientific equipment? Does that sound like a rental as opposed to a royalty for intangible property? Yeah, some reasonable number of treaties out there do have this language in there. So this is important to look for if you're looking for rental, taxation of rental. Remember, taxation of rental, if there's a permanent establishment, of course, where there's a permanent establishment, it'll throw it back into Article 7. If there's no permanent establishment, then you want to know, well, is it treated here, in which case there's a withholding tax? Or, if it's not mentioned anywhere else, do we go to Article 21, which is the other income article, and then it's covered by Article 21, which in the OECD model says only the country of residency can tax. So when you are looking for, again, how something is going to be taxed, you have to look in various places. Okay, here's Article 21. Okay, so if rental is not covered by Article 12, then we come down here, and if there's, and at least under the OECD model, it would be taxable only in the country of residence and not in the country of source. You'll recall, I guess last week or the week before, whatever, we looked at paragraph 8 of the commentary for Article 5, which was permanent establishments, and it discussed whether or not the rental of equipment was what constituted a permanent establishment or not. If it's not a permanent establishment and it's not covered by Article 12, then it ends up being non-taxable under Article 21. There's a number of types of things that can come under Article 21 that are not dealt with elsewhere. For example, financial derivatives. If a financial derivative, for example, an interest rate swap or an option over some property or something, if that's part of your real business, if you're a business hedging, if you're a business and you have some currency risk and you hedge it with a currency swap, then that's really part of your business. It's covered by Article 7. But if you're a speculator, you just decided to get into a currency swap because you thought you might have a chance to make money because you think exchange rates are going to go in one direction, that's not a business item. That's sort of an investment or speculative activity. And that's not covered in the business article. It's covered here in the other income article. This is not necessarily what you're going to find in specific treaties. It's always been a surprise to me what, the diversity in this particular article. Sometimes you find that both countries will have the right to tax. Sometimes it's written so that both countries have the right to tax income which arises in either country, but not with respect to a third country. In other words, if a resident has an item of income that arises in a third country, it specifically prevents this treaty partner from taxing them. So you have a variety of things, and it's something you have to look at closely. Okay, there's two more things I'd like to point out, I think, before we conclude, ask about any other questions, and pass out the take-home exam. The first is Article 13, capital gains. Now, understand the structure of these things. Generally, it's pretty close to this. Clearly, you do find some variety, but it's pretty close to this. And you'll have 3 or 4 paragraphs, sometimes 5, defining specific items which the source country can tax, and then all other is slopped over into a paragraph 5 or 6, whatever the last one is, which says everything else only taxable in the country of residence. And the most common thing that you have to be concerned about, I think, is the taxation of shares. Under this one, unless you have a situation where paragraph 4 applies, where you have a real estate situation, under this, any gain from the sale of shares goes untaxed. This is an example of something that you find periodically. X owns Y. X decides to sell the shares to some purchaser, and there's a gain on sale. In the U.S., we normally don't think about this very much, because if country B here were the U.S., under normal circumstances, the sale of shares of a domestic company is not taxable. Again, I'm assuming this is not a real estate situation. Normally, no taxation on share sales. A lot of countries, though, do tax, or at least attempt to tax, gain on the sale of shares of resident companies. China does this, Japan does this. So a reasonable number of countries out there do tax this. Okay, so some treaties will allow it under certain circumstances. The model does not allow it. Another thing to take a quick look at, what does alienation mean? The language in Article 13 is alienation of property. So alienation is meant to be very broad. Pretty much anything. For the last item, let's look at income from employment. Okay, paragraph 1, general rule. If an employee performs services in country B can tax him. And let's assume he's a resident of country A. And it's a physical location test. Now, paragraph 2 is an exception, which is essentially a short-term situation. Notice there's 3 requirements there. If the resident of A meets these 3 exceptions, he will be taxable only in country A, not by country B. And the 3 exceptions are 183 days or less, remuneration is paid by or on behalf of an employer who is not a resident of country B, and C, remuneration is not borne by a PE in country B. Now notice the symmetry here. Notice the symmetry. This is saying that if the permanent establishment in country B, or if any resident of country B gets a deduction for the payment of salary, then the individual will be taxable. On the other hand, if he meets the number of days and nobody gets a salary deduction in country B will not tax the salary income to the individual. That's the economics of this. It's been quite a pleasure to work with you over the past 10 weeks, and I do wish you the best in your careers, whatever you get into. And I just hope that you have even just a slight portion of the enjoyment that I've had in this crazy business, this big jigsaw puzzle that we work within.